Hi, everyone. We'll be getting started in just a couple of minutes. We're just waiting for a few more people to log in. Right. I'm going to go ahead and get started. If there's anyone else who joins, they will have missed the beginning. So, welcome to our very first webinar for Bridge Financial University called Decoding Risk and Return Strategies for Smart Investing. So, this webinar series is part of a bigger idea that I have had for a few years called Bridge Financial University, where I wanted to be able to provide tax, financial, and investment information to educate people to the level that they're interested in. Everybody's in a different place and has a different appetite for this type of information, but wanted to provide that to people at a no cost, open environment where you can also ask questions, whether they're specific to your situation or just general questions. So that idea is what eventually spawned this webinar series. So I've put together a list of topics that should carry us through probably a year at this point, doing them twice monthly. So these webinars will be held on the second and fourth Friday of each month at either 11 or 11:30, depending on my schedule. And at each session, we'll cover a specific topic. I'm starting out really generically, kind of at the lower level of complication or sophistication. So risk and return is a pretty basic topic. And nonetheless, I find it's a topic that raises a lot of questions and there's a lot of confusion. So if you do have questions, we will have some time for that at the end. So as I go through the slides, if you do have a question, if you could just write that down, and then at the end, you'll be able to either use the icon on your Zoom screen to raise your hand, and then I can unmute you and you can ask your question verbally, or there's also a Q&A icon where you can just type in your question if you don't really want to talk out loud in front of everyone. So whichever is most comfortable for you. And then we'll cover all those questions at the end. And the reason for holding the questions to the end is because we're also going to be sending this out as a replay. And it's just nicer for people watching the replay if they can just watch all the content. And then if they want to listen to the questions at the end, they can or not. So each of you that are here today will also get a link to the replay in case there's anything you want to revisit. And then in the future, if there's a webinar that you're interested in, but it just doesn't really work with your calendar, then go ahead and register and know that you'll get the replay link afterwards. And so then, even though you can't participate live, you'll still get the information. So with that being said, I also want to just note that I am doing this from my home office today. Those are my kiddos. pictures on the back wall, 3 kids, 3 sets of photos, and your puppy's here with me today. So it's possible that the Amazon guy will come and my dogs will bark. So just sorry for that in advance if it happens, but that's just one of the things that I'm just working from home. So let's get started. Okay, so our agenda for today is comprised of a few topics. So the first one we're going to talk about is understanding investment risk. What does that mean? What's the importance of understanding investment risk? Secondly, we're going to talk about return, understanding return. And then third, we'll be then putting it together, the risk return trade-off. And then fourth, I want to talk about some other types of risk that are also equally important. So I think a lot of the times on the news or whatever, they focus a lot on the market and market risk, but there's definitely some other types of risk that are equally, if not more important, that we need to think about. So we'll go over that. Then we'll just kind of tie it all together with the bottom line. And then again, we'll have time for some questions at the end. So let's hit it off. Okay, so understanding investment risk. So this is the risk that most people are concerned with when they think about investing their money. It's the possibility of losing some or all of your investment. Now, what I run into quite often is that, at least at the inception of a relationship with a brand new client, sometimes they're really concerned that they're going to lose all their money. But we have literally almost 100 years. We have 98 years of data of the stock market and how it's behaved. And never once in all those 100 years has anyone lost all their money. So whenever you hear stories of people who say like, oh, I lost all my money in the 2008 financial crisis, or I lost my money in the dot-com bust, all of those kinds of things. What really happened during those periods is that those people got scared while the market was down. They sold their investments at a low point or at the bottom of the market, and then they didn't get back in before the market appreciated. So they missed out on the recovery. So while investment risk includes the possibility of losing all your money, if you're in a diversified portfolio, in the stock market is a really unlikely scenario unless you allow your emotions to take the driver's seat and make some decisions that really harm you. Um, Investment risk is also the uncertainty associated with the returns on an investment. So we'll talk about how that's measured and how we work against, to mitigate that risk. And then there are different types of risk. So we'll go over those. So here are just a handful of the types of investment risk that you will likely experience if you're investing in the stock market, in real estate, in a large number of investments. So the first one, like I mentioned, is market risk. And this is the potential for losses due to changes in investment prices. So this is what you experience, especially if you watch the news or the stock market every day, you're going to see it goes up and down and up and down. Second is liquidity risk. So this is the risk of not being able to sell your investment at a fair price at the time that you need the money. So this comes up more often in real estate investments or even with your home. It can happen sometimes that people have not enough in liquid investments and too much in illiquid investments. And then when they need cash for whatever purpose, whether it's living expenses or something they want to buy, that's not available. And in order to get it, they would have to sell, let's say, real estate property at a fire sale price, so a lower price than you might otherwise get just to be able to get the cash. So that's liquidity risk. Next is inflation risk. I think this is something that everyone has experienced in the last couple of years, which is the loss of purchasing power. So a dollar doesn't buy as much today as it bought 2 years ago. And especially if you have any types of income that are fixed, like Social Security, which gets a modest cost of living adjustment, or pension or an annuity that pays a fixed amount that never goes up, this really starts to feel pretty painful over time. Next is credit risk, and this is the risk that investors take when you invest in companies instead of government bonds. So anytime you invest in a company, there's always the risk that they are not a good investment because of their own performance. There's the potential that they could go into bankruptcy. So, and actually, there is also some risk in government bonds. So far, not in U.S. Treasuries, but there have been some municipalities who have defaulted on bonds. So even small government bonds can carry some credit risk. Next is interest rate risk. So this is the risk associated with the fact that, especially in bonds, as an example, the value of a bond goes down when interest rates go up. And so you can lose value just because of changes in the interest rate. Next is concentration risk. This is something that we always try to work against when clients come to us. If they have a concentrated investment in a certain asset or a certain company, we always try to come up with a plan over time to work them out of that. Because if you have, it's the all of your eggs in one basket, right? So if you own a bunch of, right now Facebook might be a great stock, but we all thought Enron was a good company too, and then it went bankrupt. So avoiding concentration risk is an excellent strategy. Currency risk really only applies when you have investments that are based in other currencies besides the US dollar, but it is an issue. I do have a Canadian client who has some Canadian assets and would love to bring those to the United States, but the conversion rate is not attractive. And so there's just not, right at this time, at least, not a really great strategy for getting those funds brought over to the US. So when she travels to Canada, she spends her Canadian money, and that's the plan for now. So anyway, and then business risk is that something will happen to a company. So this is particularly of importance if you invest in a single company as opposed to in a fund that's spread across a large number of companies. So next is market risk. So the main portion of what we're going to focus on today has to do with market risk, and because that's what affects your portfolio the most. So when we say market risk, even the word risk, I think, has such a negative connotation in people's minds. But really, what we're just talking about is the volatility of any portion of your portfolio, any of the investments that you're in. So, volatility is just how much something goes up or down over time. And different asset classes have different volatility levels, and we measure those by standard deviation. So, if you can dial your brain back to maybe high school when you learned about the standard bell curve, which is what we have down here at the bottom. And the one standard deviation, so if this line here in the middle is the average, then one standard deviation to either side is going to represent 34.1% of the outcome. So if we add those two together, we get 68%. So what we're saying is one standard deviation is going to cover about 68% of the outcomes that you would expect. So if a return on an investment falls anywhere between the average minus 34.1 or the average plus 34.1, we're going to say that's within one standard deviation of the average. And then to go out two standard deviations, it's an additional 13.6 on either side. And so all four of these added together is about 96%, 95.4, something like that. So that gets you to a pretty, it encompasses really almost all of the outcomes. Now, if you remember back when the stock market hit its bottom in 2009, it was March of 2009, was the bottom of what they now refer to as the financial crisis. That was what we call a two standard deviation event, meaning that it fell outside of two standard deviations. So it was over here in this 2.1% area. And so if there's 96 in the middle and 4% on either side, that means that in 100 years you would still expect 4% of the time, or 4 times out of 100, to be either in this 2.1 on the negative side or this 2.1 on the positive side. So twice in 100 years, we would expect a market occurrence that would be similar to what happened in 2009, if that makes sense. Okay, so as an example, the S&P 500, if we look at the very long-term 98-year average, it's 9.8%. And then its standard deviation, which we're talking about the two standard deviations, typically, but it's 20 point, I'm sorry, one standard deviation is 20.81. So 68% of the time, that means we would expect the S&P 500, which, if you don't know, is just the 500 largest U.S. companies. So we would expect, sorry, Angela raised her hand. I was just checking to see if everything's going okay. If you guys can hear me, all of that. Angela, anything I need to know? Okay. All right. So 68% of the time, then we would expect the S&P 500 return to fall somewhere between -11 and +30, almost 31, which is a big range, -11 to +30. But to get to that two standard deviation level, it would have to be as low as negative almost 32% and up to 51% on the positive side. So what that tells you is 20.81 is a pretty volatile stock. And not stock, but the S&P 500 obviously is 500 stocks, but it's pretty volatile in terms of how wide the range of returns could possibly be. And that's how we measure the risk on that. Okay, so this chart is a little bit busy, but what I was trying to show you here is just different types of asset classes. So everything here in this left-hand column are the types of things that you may own in your portfolio with us. And then in the middle column is just the benchmark that goes along with that asset class. But the two most important columns here are on the right. So this column here is the expected return, and then I have them sorted by standard deviation, which is the rightmost column. And the standard deviation so the most volatile thing in your portfolio is going to be non-US emerging stocks. So that's emerging markets, which means undeveloped countries, so it makes sense that those would be more volatile because they're not developed countries. And so to have a business within a company or within a country that's not developed just carries a lot more risk. So, but at the same time, it also produces the highest expected return. So if we go down this list, you can see from emerging markets all the way down here to cash, these are the expected, or these are the standard deviations. And as we would expect, the returns are mostly going from highest to lowest as well. You can see there's a couple of outliers. For example, right here, US small company value stocks. So a value stock is a company that is basically a mature dividend paying company. So you can see that small value has a higher expected return for its standard deviation than either small cap growth or real estate. So this is one of the areas in our portfolios where we add a little bit of extra emphasis because of that. And then again, the large cap growth is a little bit lower for its standard deviation. So that's an area that we actually minimize a little bit. And then commodities, you can see only a 4.5% return with a standard deviation of almost 18. This is something we don't use in our portfolios at all. And that's exactly why. Low return, high volatility. And then from there down, it pretty much goes in order. So just a really nice view of the risk and return overall is that if you want a higher return, you're going to have more volatility or risk. If you're okay with a low return, you can have lower volatility. So that's really the big takeaway for today. So let's look at investment returns now. So typically that's measured by a percent, a rate of return, and it's just measuring the gain or loss on an investment over a certain period of time. And it's important to mention that the period of time that you're looking at for your return is really important because you can easily cherry pick any period of the last 100 years and say, oh, I hear this with gold a lot. Oh, gold's done really well. Well, it depends on what period of time that you're looking at that. And if you look at it in the overall period of time, it's not nearly as attractive as if you cherry pick the last 10 years or so. And then just also keep in mind that your return is going to include dividends, interest, and your appreciation in value. So all three of those contribute to that rate of return that we're measuring on your portfolio. Okay, and then this chart is basically, again, what's the main takeaway, which is just that low risk goes with low return, higher risk, you have a higher potential return. It's not exactly 100%, but just know that if you want less risk in your portfolio, you're going to have to accept a lower return. If you want more return, you have to be willing to accept a higher risk. Okay, so the way that at Bridge Financial Strategies we measure risk is with a software tool called Nitrogen. It used to be called Risk Alive, but apparently every software company has to keep changing the name of their software. Nonetheless, it's called Nitrogen. And for those of you who are clients, you've taken this risk tolerance questionnaire, and it helps to identify your personal risk tolerance score. And so in this case, the sample that I'm showing here, this person has a risk score of 46. This is on a scale of 1 to 100, so pretty close to the middle. And then when we see that risk score, then we compare that to different portfolios that we use, and we match it up with a portfolio that would be appropriate, similar risk score. Maybe not exactly, but somewhere in the ballpark. And then Nitrogen also provides your expected range of returns as well as your average returns. So in this case, the range for this portfolio, and Nitrogen uses a 6-month time frame. So in any 6-month period, this portfolio could be expected to fall anywhere between a negative 9% and a positive 14%. So that helps us to have a conversation with you just to make sure, both in terms of the percentage, and in this case, on a $1.4 million portfolio, that would be a dollar reduction of almost 120,000 or potential appreciation of 190,000. So just to make sure that you understand going in that in any 6 months, that would be considered completely reasonable range of returns. So if you're not comfortable with that, then we have to dial down the risk a little bit more, which means you're giving up some return at the same time. But that's part of a whole conversation that we would have. So what I've done here is I pulled up, these aren't all of the portfolios that we use, but these are some of our what we call model portfolios. And the first number here is the percentage that's in stocks or equities. And then the second number is the percentage that would be in bonds or fixed income. So in this case, you have a 40% stock portfolio with 60% in bonds. This would be the nitrogen score that's associated with the portfolio. So that's where we're trying to match that to your personal risk tolerance and pick something that's reasonably close. This portfolio would have an average expected return of 7.28%. And then this is the downside and the upside that would be considered within 2 standard deviations in a 6-month period, so short time frame. And then as we go to the right here, you can see the equities tick up by 10% each time. So if we go all the way to this end, which is the 100% equity portfolio, that carries a risk score of 76, and the average return would be 11.1. And then, but the range you can see is quite wider, as much as negative 17% in 6 months, or as much as a positive 28% in 6 months. So you can see that as you're willing to take on more risk in the terms of more equity exposure in your portfolio, you can expect a higher return. The rule of thumb is that for every 10% of equities, you gain about 1% in return. It's not perfect, but it gives you a rough idea. 6, 7, 8, 9, 10, 10 and a half, 11. So, and then, but also at the same time, as you go more towards that equity exposure, your range of returns is wider. So you have to be able to tolerate those down markets if you want to get to participate in the up markets. And then besides personal risk tolerance, obviously your financial plan is a huge component, because if you, let's say, don't have a large amount of assets and you're getting ready to retire, let's say in 10 years, you probably don't have the luxury of having a really low risk portfolio because you need that money to grow. So determining whether or not you'd be comfortable with the volatility with, let's say, one of these more middle of the road portfolios is really important, because the last thing we want to do is invest the money in the way it needs to be so that your money grows. But then you're so uncomfortable. I call it the sleep at night factor. If you can't sleep at night because of the market doing this, then it's just not going to be a good situation. So we always try to marry your personal risk tolerance with also your financial plan and the rate of return that you need in order to reach your goals, whether it's retirement or any other goal. All right, so I know you can't, these are all numbers, and I know that you definitely cannot read any of those. I can't even read them. But the purpose of this page is just to show you, this is one page out of the Dimensional Funds Matrix book. So for those of you that are clients, you know that we use dimensional funds in our portfolio, and every year they publish an updated version of this book that has a page like this for each one of the asset classes, as well as the blended model portfolios, to show the rate of return for each year. And then also we can cross-reference any 2 years on this chart to see, okay, for example, what was the return? This page is the S&P 500. What was the return between 1990 and 2000? And we can cross-reference that. But the reason I'm showing you this page is because the important takeaway is that even though this is just the S&P 500, this is not a balanced portfolio. There are no bonds in here. All of the years that were negative are colored red, and all of the years that are positive are colored black. So what you can see is that there's some groupings of red here, here, there's a few in here and here. But as we start cross-referencing more, especially more than 10 years of data, there's no red in all the rest of this. So that means as we get to more than 5 or 10 years of data, you're almost never going to have a negative return. And that's just with the S&P 500. So when people are kind of fearful about, oh, the market's going to crash, oh, this is what I heard on CNN or whatever, looking back over this is our 100 years of data basically and cross-referencing large periods of time, you can really just see that the risk gets averaged out over time. So in any 1, 2, 3, even 5 years, this is the Great Depression back here. I think this is the longest period of consecutive negative returns. It might go 10 years. But other than that, there's just really not a lot. Even if you go back to that 2008, 2009 crisis, I think the longest cumulative negative returns you would have had would have been 3 years. So after 3 years, you were back positive again. So hopefully that just gives you a little bit of confidence about the market, the resiliency of the market. Even when really, really bad things happen in the world, the market is resilient. And for this to, people use the term stock market crash, which I was thinking like go to zero, but that would mean in this case that the largest 500 companies in the US would all have to have zero value for it to happen. And it's not a very realistic scenario. Okay, so now let's move on to some other types of risk that are equally important to think about as you're thinking about your financial planning. So longevity risk is the thing that we probably focus maybe the most on, and that's just the risk of outliving your money. So when we do your financial plan and we always run it out to you living to be 100 years old, that's why, because in my experience, most people don't think they're going to live to be 100, but if they do, it's still nice to have money. That's my experience. And I'll tell you right now, we have a client who is 100 years old and is coming up on her 101st birthday next month. So it happens. And so our job is to make sure that you have money if you live that long. If you die early, you don't have a financial problem, is what I always say. And so it's my job to manage and make sure that you have enough money if you do live a long time. Next is fraud risk, and we've talked to all of the clients about getting identity theft protection and making sure that you are doing what you can do to mitigate that risk. But it's the possibility of unexpected losses due to fraudulent activity by an internal or external actor. So this can be in the form of someone hacking your accounts. This can be in the form of someone calling you and scamming you, telling you something that's not true. There's a bunch of different scams. You might get an email that looks like it's from the IRS, and there's different types. Whoops. Sorry, we have another question. Do we have a question or anything I need to know? Okay. All right. So next is what we call lifestyle creep risk. So this sometimes happens when, let's say, as you're working and you're getting pay increases or promotions and your income goes up, then you may start to increase your living expenses. So basically, you're spending that extra amount, excuse me, that you're bringing in. And the impact of that, of increasing your living expenses, is that now you will have to have saved more money by the time you retire to support a higher level of living expenses. All right, sorry, got a question. Are you guys not hearing me? Hold on. Let me see. Let me turn my microphone. Cute. Stand by. Are you are you able to hear me at all? Can one of you actually speak
Yes, you're good.
Yes.
You're just coming in and out. So just keep
to?
on facing the good way.
So it should be
Yeah,
good,
you
but
just
you know what? There's not a light on my microphone. Sorry, everybody. Let me see if I can figure out what's going on. Hold on.
I think it's just when you lean away from it, you just want to make sure you stay close to where the mic is.
I don't think it's on.
Oh, so it might be using your laptop mic if it's not on.
Okay, here's what I'm going to do. I'm going to move my laptop closer and then I will try not to move around. Is this okay?
Yes, if you stay there, yes, and don't put your arms in front of it, yes.
Don't do what?
Set your arms in front of it if you're using your laptop mic.
Okay, got it. Okay, thank you. Okay, so back to risk. Death and disability risk is the risk that your death or disability might impact your spouse, or even if you're single and you're disabled, that the loss of income and or increase in medical expenses could really impact the security of your financial plan. That's pretty much the same with illness risk. If you get sick and you have either a lot of medical expenses or you're just not able to work, that can really impact your future financial security. Divorce is always a risk. So in any divorce, the assets get split in half. And so what you're left with post-divorce is going to be less than what you might have originally been planning around. So just a risk to plan or to be cognizant of. And then dependent risk. So we're seeing this a lot where people who are planning for their own retirement are also supporting either their aging parents or their children or both, like young adult children. And so obviously the more people that you're supporting, the more money that requires. So definitely a risk that needs to be planned for as part of your financial plan. And then finally, insurance risk, which is just the risk of being underinsured in some areas. So whether there's a natural disaster, a car accident, or someone's hurt on your property, we just want to make sure that you always have enough insurance to cover those so it doesn't wipe out all the other planning that we've done just because of an unexpected event. Okay. All right, so the bottom line with risk and return is that in general, the only reason that someone would accept a high level of risk is because they expect a higher return. Otherwise, you would invest in a lower risk alternative that pays the same return. So to attract investors at a certain level of risk, you have to offer a higher return. Otherwise, it's just not going to be attractive for them to invest in. And so when someone says they know of a safe investment that pays 12%, be wary because there is no reason that that would be the case. And it's not to say that there can't be one-off investments where you can make a lot of money and you don't end up losing, but that also doesn't mean it was safe to begin with. It just happens to have worked out. So just always be careful whenever you hear about, oh, my buddy on the golf course said he's getting 12% on this deal. There's probably a lot of risk there if that's the case. All right. So does anyone have any questions? And you can type those in if you look for the Q&A icon. It'll be either, I think, at the top or bottom of your screen, depending on what kind of a device you're using. Any questions? Can I get a question? Okay, so one question that came in is how often should you check your investment portfolio if you're worried about risk? So it's a really good question because the instinct is to keep looking at it when you're worried. But the reality is that markets cycle. There are up markets and there are down markets. And that's, of course, totally normal. But like if we look at the S&P 500 for the last 98 years, the average is that the S&P is up 3 years for every 1 year it's down. So 25% of the time it's going to be a down market. So 1 out of 4 years, and the other 3 years are going to be up. Now it doesn't go in any sort of a pattern, up, down like that. It's very random. But the thing to know is that if we happen to be in a year, or it can even be a week or a month, that is a down period, looking at your investment portfolio, one isn't going to change anything, except it's probably just going to make you more upset. So I find that the clients who have the best experience with investing are those that actually look at their investments a little bit less frequently than every day. So it might be once a month. But even then, it's going to be down 1 out of 4 periods. So whether that's a month, a day, a year. So it's just, and then that's also why we have our review meetings so that we can really dive into the longer term history, not just what's going on today or what we think is going to happen tomorrow. Some of our future webinars are also going to address things like your asset allocation and that come with like interest rates or inflation and those kind of things. So definitely be more topics where we can talk about how your portfolio gets impacted. Any other questions? Try to leave us a good amount of time for questions. So, okay, so we have a hand raised. Oh, let me see. Bill, did you want to unmute and talk?
Yeah, did I just unmute?
Yes, you did. Great
Okay,
job.
good. Good. Thanks, Julie. I sent you a written question. And
Oh.
I just, also, but I hadn't found the unmute button until after I sent you the written question. But so I have a question, and you probably know every time we talk, I ask you the same kinds of futuristic predictional stuff and election results and stuff like that. So although the next time we meet, which is upcoming, at the
Yeah.
end of the month, we'll be talking about especially risk return. So that's been really beneficial for me to see this on the webinar today, because even though we talk about it every time, it's something that I need to review a little tighter with you. So I'll look forward to that. And so just one question, one comment. How do you see the rest of the year, especially with if the Fed, uh, there's just a lot of talk and a lot of possibilities there. There's interesting news in the real estate market. How do you see that running for the rest of the year? And how about the election results? What factor will they have one way or the other? And thirdly, I just want to say thank you for doing this. This has been a really good webinar for me because it's been a good update and a clarification of some things. So appreciate you guys putting this together. I know it takes a lot of work, but it's a huge help to me. So thanks, Julie. And I'll pass those 2 questions to you.
Okay, great. So again, as you mentioned, you do always have a penchant for futuristic prediction type questions, and I always steer clear of those because the reality is that there are so many hundreds of thousands of variables that affect the market that no one is able to accurately predict the market. And in one of our future webinars, we'll dive in a little bit deeper into why that's true and actually look at even mutual funds. So a mutual fund manager does nothing but watch stocks all day, every day, and they can't even beat the market. in a very large percentage of the time. So that being said, I do still have my own opinions about what I think is going to happen or what might go on. I think I just saw a uh, news blip about inflation coming in lower, and so that you know the Fed might that might affect the Fed in terms of rate decrease decision, but I haven't read enough about it to even know what they're saying. But as far as election years, there's no clear pattern in terms of how the market behaves. It does, however, tend to be more volatile during election years because everybody's trying to predict things. And so people are making all these different buying and selling decisions based on what they think is going to happen. So there's no clear pattern like it's usually up or it's usually down. It's just usually more volatile. So, and it doesn't even matter who wins, blue, red, president, Congress, doesn't matter. It's it's just there's no clear pattern in terms of the returns. I have a really good slide on that that shows historical presidencies and how the market has behaved, and it's not what you would expect most of the time. So that's that. We focus on what's on the diversified portfolio and just keep you know, from that concentration risk. So we have a little bit in all these different parts of the market. And so however it works out, we know that over time, we're going to expect 3 up years, 1 down year, and that's just what we can expect for the long run. Does that
Okay.
answer your
Thank-
question?
Yes, thank you.
Okay, good. All right, so I have another question. Can you change your risk tolerance or how often do you look at this for your clients? So we have our clients take the risk tolerance, the nitrogen test about every 3 years. And that's just to see if your risk tolerance has changed. One thing that I know from my experience is that people typically overestimate their risk tolerance until there is a down market. And so to reevaluate it when there is a down market is a really good exercise to make sure that people's risk tolerance has not changed. But over time, I would say people tend to either be more comfortable with the market or less comfortable, and that doesn't change too much. And also within couples, it's not uncommon to have one spouse that's got a higher risk tolerance than the other spouse, but yet our job is to invest the money in a unified way that both spouses are comfortable. So sometimes we have to kind of meet in the middle, but the way that we accomplish that is when they take the risk tolerance test, we have them agree on the same answer to each question so that when we get to the end of it, we have a single risk score that represents the input from both spouses. All right, another question. If I am 35 and take the risk tolerance test and get a very low risk score, would you recommend I adjust my risk? Okay, so I think this is a question around if I have a low risk score and I therefore decide on a lower equity portfolio, is that going to get me where I need to go? And if I'm 35, I have potentially 30 years until I need that money. So are we going to have a conversation about that? And the answer would be yes. But at the end of the day, that sleep at night factor is still critically important. And if you're the type of investor that just really can't tolerate market movement, then you know we're going to have to, I mean, you just have to save a lot more of your own money if you don't want to allow the market to grow it for you as much. So there's different options. The thing that I really love about financial planning is that there are so many variables that you can play with to get to the answer that you're looking for, which is a secure financial future. So you can save more, spend less, work longer, retire earlier, live longer, die sooner, although we don't usually recommend that option. So anyway, there's a lot of ways to get there, but I think just the whole process, the point of that is to help you understand, like, these are the things I get to have control over. I can choose how long I work, I can choose how much I save, this and that, but other things I can't control. I can't control the market. So if you're really uncomfortable with it, then plan on saving a lot of your money, and then we can put you in a lower equity portfolio. Okay, that's all the questions I see. I don't see any hands raised. Is there, just, I'll give you just another minute or two to see if anybody has a question. And actually, while we're doing that, I will go ahead and talk about our next webinar. So 2 weeks from today, on Friday, July 26th at 11:30. Today's was at 11, the next one will be at 11:30. And the topic will be strategic asset allocation, maximizing returns and minimizing risk. So I consider today's webinar like step one. That one's going to be like the next level. So once you understand risk and return, then we can talk a little bit more about your asset allocation. And then also, just to give you an idea of the other webinars that we have queued up for future weeks, these are the dates and topics. So on August 9th, we'll be going over the difference between mutual funds and ETFs. And then on August 23rd, that's going to be the one on dimensional funds and why do we use dimensional funds in your portfolio. And then on September 13th, Angela will be facilitating that webinar, and it will be a tour of the Schwab website and showing you how to find things and or do things that you want to do. And then on September 27th, avoiding financial scams. So this goes back to addressing the fraud risk that we talked about and just some common scams that we've seen, how you can protect yourself from getting taken advantage of by any fraudsters. Then on October 11th, we'll be talking about interest rates and investing and how they tie together. And then on October 25th, it'll be the inflation topic. So understanding inflation. All right, let me just check the questions again. Okay, so another question. Would risk change if you're going through a life event or say saving for a home? So that's a great question. And definitely life events can affect your risk tolerance. So that's a good time to really recheck that. And as a lot of you know, I do help people who are going through divorce. And that is one of the first things we do post-divorce is have them take the risk tolerance questionnaire as a single person, because it's likely different than the combined score when they were married. And it may also be a little bit lower just because going through divorce can be a pretty financially scary time in your life. And so whether it's permanently or temporarily, it could lower your risk score. And so you always want to revisit that. And then as it relates to like saving for a home, that doesn't really affect your risk tolerance, but it would affect your financial planning. So we just got this great new software that has these, what they call target maps. So when you have a goal like saving up for a down payment, it plots it out and it shows like what percentage of the way you are toward reaching your goal. So I'm pretty excited about using that with people. So it could be buying a house, it could be paying for college, it could be saving for retirement. You can have all these different goals, and then it shows you like a little, I don't know what you call it, like the percentage thing of how close you are to your goal. So that's really what would more be affected by having a goal like saving for a house, is we would adjust like, okay, maybe in the past you've been a great saver contributing to your 401k, but maybe for the next 3 years you change that and divert some money into a fund to save for your down payment, something like that, but it's not really a risk discussion. Right. Well, I think that's it for the questions. So sorry about the sound issues. I will work on my microphone. I don't know why it has no power. We'll get that worked out for next time, but I hope you're able to come back in 2 weeks, or at least if not, you can register and get the replay if you'd like to watch that. One great thing about the replays is you can always watch them on a little faster speed if you don't have full amount of time. So I sometimes do that where I don't participate live, but I get the replay and I watch it at 1.25 speed. So little tip there. All right. Well, thank you everybody and see you in 2 weeks. Take care. Have a great weekend.